All right, so let's take a look at the week ahead. Now, as a predominantly risk-averse trader, as you guys know, I always look forward to weeks that are heavy on the high-profile tier one economic risk events. And the reason for that, of course, is it's obvious. It increases our chances of getting high probability trades, right? However, every now and again, we get weeks like this week where the calendar is rather thin and there is only a handful, really a small handful of big events to look forward to. So even though it's a busy week in the sense that we still have earnings going on in the background, we have two central bank policy decisions. There are plenty of central bank speakers. There aren't as many major risk events on the lineup, but at least we do have a few to get excited about. Now, just to put it into context, I mean, if you scroll through this week, if you scroll through this whole week, it looks busy. There's a lot of data. But if we strip out all the ones that we won't be paying attention to, then that's really all we've got left with, which is not that exciting. But obviously, if we get some big surprises out of these, it can make up for it. So let's start with Monday. I mean, today is a complete snooze fest on the data side. We do have some central bank speak coming up, I believe. Let's just refresh this. We do have some central bank speak coming up. We've got SNB Jordan a little bit later in the session. I doubt that we're going to get anything from him on the monetary policy side, though. He's only going to be talking about CBDC, so I'm not expecting much from that. After him, we also have Barkin. We've got Williams coming up. Now, these will be more important, more interesting after the Fed's decision that we had last week, as well as the recent data, obviously. Now, like you guys know, I'm short the US dollar at the moment, and these Fed speakers are the biggest risk to my trade, because if they come out and they push back against Powell's more dovish remarks and talk up the possibility of hikes, and they talk up their stress about the inflation data, and they talk down the recent soft patch that we've had in growth data, anything in those lines, that could see upside risk for the dollar. So that is a risk that we'll just need to be watching in that commentary, not just for the central bank speak today or tomorrow, but obviously throughout the week. That's something we just need to be paying attention to. So then in terms of tomorrow's schedule, that's where things start to just heat up a little bit again, because then we go into the RBA policy decision coming up tomorrow during the Asia Pac session. For this event, things are very interesting right now because, a few weeks ago, as you guys know, we tilted more bullish on the Aussie in anticipation that markets were, at that time, underpricing the risk of a more hawkish RBA, at least one that had to leave rates higher for longer than what the markets had, expected just a few weeks ago. And I mean, that played out quite well. It gave us some really decent trades in the Aussie. I mean, we had a beautiful trade to the upside in the likes of the Aussie Kiwi, as you guys know. We had a couple of good trades in the Aussie Swiss franc, trading that higher. We had a couple in the CAD, a couple of versus the US dollar. The Aussie has paid off. That bullish view has definitely paid off in the last few weeks. But I do think going into tomorrow's meeting that markets are getting a little bit too hawked up, just like they did with the Fed last week. Not as intense, not as aggressive, but I do think that's the case. Even though there's a slim chance, if we look at interest rate expectations right now, if you look at the RBA expectations, this is just looking at what the markets are expecting from rates, what they're expecting from basis points going into the next few meetings. If you take a look at the RBA, there's a extremely slim chance that anything happens on the rate side tomorrow. But even with that 92% probability of a hold, there's actually a few participants out there calling for a hike tomorrow, and you've got plenty of other ones calling for hikes, one hike or two hikes or three hikes later in the year, which I think they are taking things too far. Many are pinning the RBA now as being behind the curve and pinning a very similar view on the RBA like they had for the Fed last week. But the two economies, guys, they are so different right now, whether you look at growth or labor or inflation. The RBA has far less wiggle room on the growth and the consumer and the housing side to even think about hiking rates right now when you compare that to the Fed. So, and think about it this way, if you were the RBA, I would not want to overreact to one higher than expected print, to just jump right back into a very hawkish stance. I mean, they gave themselves the flexibility last time in their statement to go either way. They said, listen, we are up for anything right now, on any direction in rates, whether it's going to be up or down. Yeah, I don't see why they have to change that view tomorrow. Yes, they should acknowledge the higher surprise on core inflation that we had, but they should also acknowledge that progress has been made, and one print doesn't change that. I mean, take a look at the charts. Let the charts speak for themselves. Here you have the trimmed mean, which everybody is saying, wow, because of this, they have to hike. Well, I mean, yes and no, right? They are making progress. Is it slower progress than what they would have hoped? Absolutely it is. But it's not like we're moving in the wrong direction right now. We're still moving in the right direction. Same story with the weighted, not as important, but still important. That's more flatline, but it's not like we're moving up. We're slowing down slower, if that makes sense. This for me resembles the charts that we were looking at for the Fed, right? In terms of US inflation. Let's go there for a second. Should be this one. Here we go. It resembles what we were looking at for the US. When you look at core CPI and core PCE, the trends are still intact, right? What we've been saying over the last few weeks is that, yes, the markets are very stressed about the upside surprises that we've had in core inflation. But if you look at the chart, we just don't see the angst. We didn't see the reason for why the Fed would want to come out last week and just, go ass to grass hawkish. It just didn't make sense based on the data. So I think that same view poses downside risk for the Aussie. Obviously, think about it this way. If I'm wrong and they are very hawkish, we're going to trade the Aussie higher anyway, right? We are medium-term bullish the Aussie. So if I'm wrong and they do shift super hawkish, then we just buy the Aussie. It's very simple, right? If they do come out and they hike rates, I mean, obviously we just buy the Aussie. So we're not trading into this event. We'll be trading out of the event. So my view doesn't matter when you consider that. But because the markets are now more hawkish, the risk is that if they come out and they do nothing tomorrow, which I think makes the most sense, that in itself poses downside risk for the Aussie. Not because they will be, dovish, but because they won't be as hawkish as the markets are now arguably pricing them in to be. So that's important to understand. Now, apart from the RBA, and again, as usual, we will have a full video preview available for this a little bit later with a trade plan. Now, in terms of the rest of tomorrow, it's going to be very, very quiet and nothing to be excited about. That's the same story for Wednesday as well. Tomorrow and Wednesday on the data side is just an absolute snooze fest. We've got a couple of central bank speakers, though. We've got Kashkari tomorrow. We've got Jefferson, Collins, and Cook coming up on Wednesday. And again, the focus there will be on the dollar and what they have to say about the Fed, inflation, etc. Then on Thursday, we get the next Bank of England policy decision. Now, looking at rate expectations, there's something I wanted to just add here. If you take a look at the BOE rate expectations, the BOE right now, according to the markets, are expected to start cutting rates in August. Now, I know that financial media releases will say that the first hike is only fully priced in for September. And theoretically speaking, that is correct. But I think that's also kind of deceiving when you look at the numbers. And we've spoken about this many times before. For example, according to short-term interest rate futures this morning, this is the update from this morning, the markets are implying 24.55 basis points of cuts for the Bank of England for the August meet. Is that a fully priced cut? No, it's not. But geez, like it at less than half a basis point, that doesn't mean that the markets aren't expecting a cut for August. They're just not 100% pricing it in, right? But 98% is pretty much there for a cut. So just keep that in mind, when they talk about fully priced in cuts and fully priced in hikes or whatever, just, look at the data, this tells us that August is still the highest probability play from a short-term interest rate point of view. Now, when it comes to the Bank of England, as always, it's going to be all about guidance and commentary for this bank, for this meeting. Now, there's been an interesting divergence among the Monetary Policy Committee over the course of the last 3 weeks. A few sessions ago, we heard from Governor Bailey, as well as Ramsden, that their view of inflation has changed a bit. Both of them sounded confident that inflation is moving in the right direction, dismissing the idea that the upside surprises in US inflation has any bearing on the UK, which I think is an accurate assumption right now. Now, that more hawkish than expected comments saw a huge rip to the upside in euro sterling a couple of sessions ago, because that kind of reduced the higher for longer view for the Bank of England by quite a bit. Then a session or two later, we had Chief Economist Pearl coming out saying the exact opposite, pushing the pair right back down again, right? So we had Bailey and Ramsden pushing it up, and then Pearl coming back saying, no, let's not get too aggressive. I don't think inflation is on a guaranteed path lower, and he thinks rates are probably going to stay higher for longer. Now, where does that leave us for the Bank of England on Thursday? Look, the main focus that the markets will have is whether that view change that we've had between Bailey and Ramsden versus Pearl, where does the balance of the MPC place their votes? Do the majority of them think inflation will move lower? If that's the case, then they could opt for, start making more noises towards cutting rates, potentially in August. And if they don't and they push back against it, which I think is unlikely, for example, if they follow Pearl's views, which I don't think will be the case, but we need to keep an open mind, that can obviously see a lot of upside for sterling if that's the case. But I think there's more downside risk, because if you look at inflation, yes, we've got a long way to go in core inflation for the UK, but with the energy stripped out of the upcoming inflation prints, we're expected to be very close to that 2% level very soon. So I do think that August is probably the highest probability outcome for a cut from the bank, and obviously Thursday will go a long way to change markets or confirm markets' expectations of that view. So that's it for Thursday. Then on Friday, and as always, again, for the Bank of England, we will have a full preview available for that a bit later in the week. Then on Friday, we get a couple of interesting data points. We get GDP data out of the UK, we get the Canadian jobs report, and we get the next batch of University of Michigan sentiment data for the US. Now, in terms of UK GDP, the main focus for how we will be looking to trade this GDP data will be largely dependent on the outcome of the Bank of England the day before. So we'll discuss how we are looking to trade that GDP data on Thursday after we've had the Bank of England. Then we'll do a preview and a trade plan for that, because that will largely dictate it. So I'm not going to talk about it now. We'll talk about it later in the week. In terms of Canadian jobs data, this one will be an interesting one. I mean, if we take a look at market expectations right now, markets expect the bank to start cutting rates. Well, there's a 72% chance, 73% chance of a cut for that June meeting. Now, at 70%, there is a bit of two-way risk for that jobs print. That means that if we get either a big miss or a big beat, could be tradable in the short term, because let's just assume we get a massive miss across the board. That will obviously be enough to push that 72 maybe up to a high 80, low 90, which will, in the market's view, kind of seal the deal for a cut in June, and that could still place some downside pressure in the CAD. Alternatively, if it's a huge upside surprise in labor, in the jobs report, that could see that 72 reduce closer towards a 50-50, which once again could be good for the CAD, especially if you consider that positioning on the CAD is still rather stretched to the downside here, for the Canadian dollar. So that could be good either way. Fundamentally speaking, medium term, I am still bearish the CAD. We've had a couple of good trades in the CAD over the past few weeks, with that bearish view, because we've been anticipating, after that big miss we had in inflation, that the path for the BOC will be more aggressive on the cut front than the markets anticipated. And what's interesting, if you take a look at what is expected by year end for most of the major central banks, if we were to, for the majority of this year, the markets have expected the ECB to be the most aggressive one to cut rates, to cut the most, to start the earliest and cut the most. If we see a massive miss in the jobs data for Canada, that's probably going to put the BOC as the most aggressive one to cut this year. And that could put some downside pressure on the CAD, despite positioning being a little bit on the stretch side for that. So that's also one to watch. When it comes to the University of Michigan data, this one is going to be more interesting because of that consumer confidence data we had a couple of sessions ago. I mean, if we take a look at consumer confidence, let's just quickly go there. If we go to, should be this one. Yeah, quite a big miss in consumer confidence back to July 2022 levels. So the big question mark will be, is this followed through by the university sentiment data as well? Is it just a one-off? Do we see an upside surprise? So that whether there's a divergence or a confirmation of sentiment breaking down, that's what the market's focus will be on Friday. And obviously, as always, as we've seen in this cycle, big focus on the consumer inflation expectations 1 year and 5 year as well. Big upside surprises, obviously, good for the dollar, good for yields, bad for equities, and a downside move, obviously, the opposite. So what I will be looking for, obviously, from a dollar short perspective, I'll be hoping for a downside surprise in both sentiment as well as inflation expectations. If it's a mixed bag where sentiment comes in really bad, but inflation comes in really good, that's not too great, right? That's more of a stagflation print, which isn't necessarily that bad for the US dollar. So that's just something worth keeping in mind. Now, apart from economic data, we do have another batch of earnings. Now, keep in mind, normally after we've had those big tech names, we still have NVIDIA obviously coming up, I think next week or the week after that. No, it's next week, I think. But we've had all of the the other major tech names out of the way. And normally that means that even though earnings season remains super busy, as we can see here on the calendar, we don't have a lot of those big high profile names coming up, right? So if you are an individual stock trader, this is still a great week for you because we do have important names like Walt Disney coming up. We've got BP coming up. There is bigger names in the mix, but it's not going to be as important as the last 2 weeks when we had those really big tech names coming out. And that's also confirmed when you look at the earnings expectations for those highly anticipated names. Let me just quickly bring that up. You can see that it's Berkshire, Vertex, Walt Disney, and Airbnb. Here you have the quarterly and full year EPS estimates, the highs and the lows, as well as the revenue highs and lows. And you can see the weighting. The weighting is not nearly as aggressive. So just to put this into context, let me quickly bring up the one from last week. If I bring up the one from last week, you can see the weightings was just massive for those names like Amazon, like Apple. So we don't have those types of big weightings, but we still have a close to 2% for the likes of Berkshire and the S&P, close to 2 or just over 2% for the Dow with Walt Disney. So we are expecting an impact, but not nearly as much as we did with those prior earnings that we had over the last 2 weeks. So just keep that in mind. And then obviously we spoke about the Fed speakers coming up this week as well. That is definitely important to keep on the radar as well. All right, guys. So that is everything from a week ahead point of view. As always, any questions on this, don't hesitate to let me know.